Hi, this is Pete Birchler of StockMarketAlchemy.com. It is Monday, April 1st, after the close in the U.S. markets here. I'm going to do a brief review of the most recent Commitment of Traders report data so we can stay on top of what the smart money and the large money is doing. This chart shows the commercial net positions. There was a relatively minor change towards the net long side off of their record net short position for the bull market as of last week. So no real significant change. We still have a major COT sell in effect from last week. What we're really looking for at this point is to use this information in combination with some type of sensible technical trigger, chart pattern, or that type of thing in order to either exit long positions, take protective action on long positions, or to enter speculative short positions. So let's briefly talk about what some of those triggers could be. First off, let me move to a weekly chart of the S&P 500. This is the S&P 500 cash index. A couple of different stochastic studies down here. What I want to note here is that the stochastics over the last couple months, this weekly chart here is creating at this point a bearish divergence on the stochastics indicator. Now, there's no confirmation yet on that, but if we do see the market roll over for a week or two here, and we see this blue line, this percent D line, cross back down below 80, that would be a reasonable sell signal as far as the stochastics indicator goes. So when you see this extended movement of the percent D line up above the 80 level, and then you see it come back down below the 80, that's often coincident with a high in the markets or slightly after a high. So that would be one simple indicator to look at here that is showing some topping action. Now, on a shorter term basis, what I want to look at here, this is an hourly chart of SPY, the S&P 500 ETF. And the point that I want to make here is that first off, we have a failed breakout of the March 14th high as of the last couple of days. So it moved above it slightly, just by a few pennies, and then has reversed back below it. And today, the reversal held and the price closed below the midpoint of its range. If prices trade below today's low tomorrow, that would be a reasonable short-term short entry. Entering at a break of the low with a stop above this high, targeting this low here from March 19th, and probably even lower than that. So that's my thoughts on the short-term pattern here. Now, on a pattern note, one thing that's interesting here from a traditional Elliott wave standpoint, after this February high, we saw this ABC type of correction, and then since then we've seen a possible something like a 1, 2, 3, 4, and possibly a overlapping diagonal type of movement for a wave 5, so a ending diagonal type of movement. Now, I don't know that is the case. I don't put a lot of weight on some of these traditional Elliott wave patterns here. However, one thing I do think is significant is when we do see this type of overlapping move going on into a high or a low after an extended trend, I do find when you couple that with technical divergence that does tend to be a relatively reliable type of chart pattern here. What I think is more useful when you look at these patterns is to combine, don't just look at the pattern in and of itself, but you have certain rules and requirements of what price must do to confirm whether what is occurring, what you think may be occurring based off of the pattern, is actually occurring or not. And when you see a diagonal, potential ending diagonal like this, let's just get rid of this chart here. Let's say we're looking at this as a diagonal type of triangle here moving up. Then what we should see is the market rapidly move back down below the beginning of that diagonal triangle when that occurs as a wave 5 or an ending patterns. So this vertical line here as of April 5th would be typically we should see price back below this level by that time frame if this is indeed the final phase of this push up here. So given the divergence, that's possible, but if the market trades higher tomorrow, that wouldn't be a great confirmation of this. And if we see the market even just chopping around for several days here, again, that would not be good confirmation. At this point, if a high is in place on this failed breakout, we should see the market rapidly move back down below this low here, possibly just within the next 1 to 2 days, most likely. So that would also be a possible technical trigger, is to wait for a rapid break of this low, and if that occurs, enter short with a stop above this high. If you're going to do that, obviously you need to have some type of trade management strategy in place for exiting positions or trailing a stop if this does turn into a larger decline. On a seasonal note, the typical seasonal weakness comes in as of the end of April. There's the old adage, sell in May and go away. And while that doesn't always occur, it is a relatively reliable historical pattern. So as we move into April here, if we do see any type of technical triggers giving flashing sell signals in stocks, I think that's something to pay attention to, given the seasonal tendency for stocks to experience corrections in that May time frame here. So that's really what I wanted to cover for this update. I plan to do an update on bonds here relatively soon. I think bonds are in a very interesting position currently. As a brief note on gold, sentiment has been extraordinarily bearish towards gold given the typical historical range. So if we move to a chart of gold here, this is a GLD ETF. If prices can hold above this February low, based off of the extreme bearish sentiment on gold and this rather extended correction, if we do see prices break out above these highs here around 157 on GLD, that could set the stage for a significant advance in gold. But if we see prices break below the February lows, that would be relatively out of character for a bull market correction. That would make this an extremely long correction. So given the larger context here, there's a pretty clear support. If we move to let's move to continuous futures. There's a pretty clear support here around the 1530 level in gold prices. So if we do see prices break below those February lows, and we do see these support levels taken down after 3 significant bottoms in that range, and it breaks that a 4th time, there could be some significant downside below that. So I would be looking at that in gold, making sure we're taking protective action below the February lows. If it does break that, could certainly open up to the downside to a significant extent. So that's just a few high points here on some different markets. If there are any specific markets anybody would like looked at here over the near term, leave something in the comment section, and over one of the next videos we'll see if we can do that. So that's all for now. Have a great day. All the best to your trading.